Imagine the most sophisticated ballroom in New York or a sun-drenched private golf course in Palm Beach. In these circles, people do not just have money, they have power, intellect, and access to the finest advisors the world can offer. These are individuals who built empires and managed global portfolios, the kind of people who are supposed to be impossible to fool. Yet in December 2008, all of them woke up to the same nightmare. They discovered that their wealth was not sitting in a secure vault, but had vanished into the largest financial black hole in history. We are often told that victims of fraud are the desperate, the uneducated, or the elderly who do not understand how a bank account works. But the story of Bernie Madoff shatters that myth completely. His victims included Nobel Prize winners, Hall of Fame athletes, and the most rigorous hedge funds on Wall Street. How did the brightest minds in finance allow themselves to be led to the slaughter for over 20 years? The answer lies in a paradox. Madoff did not lure them with flashy promises of getting rich quick. Instead, he exploited their desire for something far more addictive, the feeling of being special. He turned a massive lie into an exclusive privilege, making the world's most powerful people feel lucky to be his victims. To understand the scale of the deception, one must understand the weight of Madoff's credentials. He wasn't just a successful broker, he was an insider who helped build the modern financial system. In 1971, a new electronic stock market was born called NASDAQ. Unlike the traditional New York Stock Exchange, where traders shouted on a physical floor, NASDAQ was the world's first electronic marketplace driven by computers. Madoff was a pioneer of this system, and his firm was one of its largest market makers. By the early 1990s, he had risen to become the chairman of NASDAQ. This gave him the ultimate seal of approval. He was no longer just a participant. He was the man who helped write the rules of the game. When regulators from the SEC came to visit, they weren't looking at a suspect. They were looking at a titan of the industry whose advice they often sought. However, this untouchable reputation became the foundation for his fraud. In the early 1990s, when a market downturn hit, Madoff's legitimate investment strategies began to fail. He couldn't generate the steady returns his high-profile clients expected. Facing the choice between admitting failure or maintaining his status as a prophet, Madoff chose the latter. He began using capital from new investors to pay out those who wanted to withdraw, effectively starting a Ponzi scheme. He convinced himself this was a temporary fix to bridge a bad quarter. But because of his status at NASDAQ, nobody dared to perform a deep audit of his books. He realized that the system was built on a blind trust in his name. This realization allowed him to move his fraudulent activities to the 17th floor of the Lipstick Building. There he stopped trading stocks and started trading exclusively in illusions. Madoff's success wasn't based on complex sales pitches. In fact, it was based on the opposite: silence and exclusion. He targeted the elite social circles of Palm Beach and New York, but he never asked for money. Instead, he cultivated an aura of mystery. When a billionaire approached him at a country club, Madoff would often act as if he were doing them a favor by even considering their investment. By telling people the fund is closed, he triggered a psychological reflex. The more he pushed them away, the more they begged to get in. He turned an investment account into a status symbol, much like a limited edition watch or a private jet. The billionaires who gave him their money weren't stupid, but they were victims of their own confirmation bias and a desperate need to protect their reputation. They saw Madoff's steady 1% monthly returns as a private loophole that only they were privileged enough to access. But beneath the surface, there was a darker psychological pact. Many of these titans had a sneaking suspicion that the numbers were too perfect. However, in the world of high finance, your reputation for being in the know is more valuable than the cash in your vault. To question Madoff was to admit that you, the brilliant tycoon, didn't actually understand the secret sauce. Even worse, if you discovered it was a fraud and spoke up, you risked appearing like a fool who had been duped, shattering the image of invincibility you had built for decades. Their advisors were equally paralyzed. They were paid massive fees to perform due diligence, but they often failed for a simple reason: they didn't want to lose their own access to the Madoff inner circle. A handshake with Bernie at a golf course became a substitute for auditing his books. It was a mutual agreement of convenience and collective silence. Madoff provided the illusion of zero-risk growth to stroke their egos, and the wealthy provided the fresh capital and the protective silence to preserve their own status. They weren't just investing money, they were investing in the preservation of their own prestige, making them the ultimate accomplices in their own destruction. While the world's elite were busy protecting their prestige on the 18th and 19th floors of the Lipstick Building, the brutal reality of their investments was being manufactured just one floor below. To understand how a lie survived for 20 years, we must enter the 17th floor of the Lipstick Building in Manhattan. This was a parallel universe. While Madoff's sons and legitimate brokers worked on the 18th and 19th floors, in a modern Wall Street environment, the 17th floor, often called the secret bunker, remained frozen in time. It looked like a 1970s back office, cluttered with outdated computers and massive stacks of paper. Access was strictly controlled. Even Madoff's own sons were barred from entering without his explicit permission. The staff here weren't Harvard-educated analysts. Madoff intentionally hired high school graduates and blue-collar clerks. These employees possessed no specialized financial knowledge to question the operations, ensuring a workforce built on absolute, unthinking loyalty. The sole mission of the 17th floor was the industrial-scale production of fake account statements. The core of this operation was a process called backdating. Madoff would wait for the markets to close, identify which stocks had performed best that day, and then order his staff to print trade confirmations with past dates. This fabricated a track record of buying low and selling high that was impossible in real-time trading. They used legacy computer software to churn out millions of pages of reports carefully calibrated to match the steady 10% to 12% returns Madoff promised. Madoff. When the SEC arrived for inspections, the 17th floor turned into a theater. Staff would frantically print documents, intentionally staining them with coffee or crinkling the paper to make them look like decades-old records. Madoff would then overwhelm inspectors with this mountain of physical evidence, claiming his proprietary computer systems were too old to access digitally. This forced the exhausted regulators to perform manual checks until they gave up. The most profound deception involved the Depository Trust Corporation, DTC. Madoff told clients their stocks were held in custody at the DTC, the world's largest central depository. In reality, not a single share was ever purchased. The investors' billions sat in a standard Chase bank account, which Madoff used like a personal slush fund to pay off those who wanted to withdraw. The entire multi-billion-dollar empire rested on a simple, unchecked claim. For nearly 20 years, the fraud persisted because the SEC failed to perform the most basic audit task, making a single phone call to the DTC to verify if Madoff's holdings actually existed. While the 17th floor was busy manufacturing paper trails, a math expert named Harry Markopoulos discovered the truth. Markopoulos wasn't a federal agent. He worked for a competing firm and was tasked with figuring out how to replicate Madoff's success. But as he analyzed the numbers, he realized it was mathematically impossible. He looked at the trading volume of the stocks Madoff claimed to be buying and found that on many days, Madoff would have had to buy more shares than actually existed on the entire market. In 1999, Markopoulos sent a detailed report to the SEC titled "The World's Largest Ponzi Scheme." He showed that Madoff's performance curve was a straight line pointing upward, something that never happens in a volatile real-world market. However, the SEC failed to act for nearly a decade. This failure was rooted in a blind respect for authority. The young investigators at the SEC were often intimidated by Madoff. When they questioned him, he would drop names of powerful people or remind them that he had helped build the NASDAQ system they were using to track him. He treated the regulators like students and himself like the Dean of Wall Street. Instead of asking for bank statements or calling third parties to verify his trades, the SEC auditors spent their time checking the very documents Madoff's staff had forged at the Lipstick Building. They were looking at the shadows Madoff cast on the wall, rather than the man behind the curtain. For 10 years, the government's eyes were wide open, yet they chose to remain blind. because they couldn't imagine that a titan like Bernie Madoff could be a common thief. The end of Bernie Madoff's empire was not brought about by an SEC investigation or a sudden burst of conscience. It was destroyed by the 2008 global financial crisis. As the housing market collapsed and major banks like Lehman Brothers vanished, a wave of panic swept through the world's elite. For the first time in decades, Madoff's clients weren't looking to invest. They were desperate to withdraw. In late 2008, investors requested a total of $7 billion in redemptions. But the investments on the 17th floor didn't exist. There were no stocks to sell, only an empty bank account that had been bled dry to pay for decades of fake returns and a lavish lifestyle. Madoff, the man who had cheated the market for 20 years, was finally cornered by the one thing he couldn't manipulate: a liquidity crunch. On December 10, 2008, the illusion shattered behind closed doors. In his luxury Manhattan apartment, a broken Madoff confessed to his sons, Mark and Andrew. He told them that his entire investment firm was one big lie. He had hoped to use his final $300 million to pay out bonuses to his inner circle. But his sons, horrified by the scale of the betrayal, reported him to the authorities the next morning. The arrest of Bernie Madoff sent shockwaves across the globe, not just because of the $65 billion lost, but because of the pedigree of the victims. Wealthy families, major universities, and international charities discovered their futures had been funded by nothing but paper. The human cost was devastating. Legendary French financier Thierry de la Villehouche reached a tragic finality in his office after losing $1.4 billion of his clients' money. Even Madoff's own family could not escape the toxic legacy. His eldest son, Mark, was overcome by the unbearable weight of the shame and suspicion. Mark met a heartbreaking end exactly 2 years after the arrest. Bernie Madoff had built a castle on sand. And when the tide finally came in, it took everything and everyone he claimed to love with it. The fallout of the Madoff scandal transformed the financial world, but the true damage wasn't just the $65 billion. Bernie Madoff was sentenced to 150 years in prison, a symbolic term for a man who had erased the life savings of thousands. However, the more permanent sentence was handed to the global financial system, which suffered a total collapse of public trust. The scandal proved a chilling reality that our regulatory institutions were more protected by Madoff's reputation than by their own oversight. It revealed that in the high-stakes world of finance, prestige often acts as a blindfold, preventing even the most sophisticated experts from asking the most basic questions. Today, the 17th floor of the Lipstick Building is empty, but the ghost of Madoff remains a permanent warning. He didn't just steal money, he exploited the human desire to feel exclusive and special. The lesson for every investor today is that transparency is not an option, it is a necessity. If you cannot see the gears moving behind the machine likely isn't working. We are reminded that any investment offering a world without risk is by definition a lie. As we look at the digital markets of today, the question isn't whether another Madoff exists, but whether we are still willing to trade our skepticism for the comfort of a beautiful illusion. What do you think? Has the financial world truly learned its lesson since 2008? Or are we seeing the same patterns of exclusive traps in today's crypto and digital markets? Have you ever walked away from a deal that felt too perfect to be true? Share your thoughts in the comments below. If this article gave you a new perspective, please like and subscribe to help us bring more of these stories to light.